Technical Analysis of the Financial Markets, by John J. Murphy. Introduction. Imagine for a moment that you're standing on a beach. The sun is warm, and you're watching the ocean. You see the waves crash on the shore, one after another. Some are big, some are small. To the casual observer, it's just a beautiful, chaotic dance of water and sand. Random, unpredictable. But you know better. You know that beneath the surface of those crashing waves, there's a deeper, more powerful force at work. The tide. The tide is moving in, or the tide is moving out. And if you watch long enough, you can see its direction in the pattern of the waves. You can see the story the ocean is telling. Now, imagine the financial markets, the stock market, the crypto market, any market, are just like that ocean. Every day, you see the waves of price changes. Up a little, down a little. It looks chaotic. It feels random. It seems like you need a supercomputer or an army of economists to make any sense of it. But what if I told you there's a tide in the market too? A deep, underlying trend that you can learn to see, not by studying complicated economic reports, but by simply looking at a picture of the price itself. What if the market has a language, a story it's telling every single day, and all you need to do is learn how to read it? This is the profound promise of a field called technical analysis. And for decades, there has been one book that has served as the undisputed guide to learning this language. It's been called the Bible of the field. It's used by the Market Technicians Association to certify its top professionals. It has even been cited in research studies by the Federal Reserve. That book is Technical Analysis of the Financial Markets by John J. Murphy. For over 30 years, Murphy has been a guiding light in this world, from serving as the Director of Futures Research at Merrill Lynch to being the trusted on-air analyst for CNBC. He didn't just write about this topic, he lived it, breathed it, and taught its principles to millions. And today, we're going to step into his world. We're going to learn the language of the charts. My promise to you is this: by the end of our time together, you won't just see random lines on a screen anymore. You will see stories. You'll understand the timeless psychology of the crowd, the epic battles between buyers and sellers, and the hidden rhythms that drive the markets. You'll be given a foundational toolkit to begin decoding the story of any market in the world, and you'll see that underneath the chaos, there is often a beautiful, simple logic waiting to be discovered. So, let's begin our journey. Let's learn to read the tide. Book summary. Before we can read the stories written on a chart, we first have to accept a certain worldview. It's a philosophy, really, built on three simple but powerful beliefs. If you can embrace these three ideas, the rest of what we discuss will unlock a new way of seeing the financial world. If you can't, the charts will forever remain a mystery. John Murphy lays these out as the very foundation of his entire approach. Think of them as the three unbreakable rules for understanding the market's mind. The first rule is this: market action discounts everything. This is the cornerstone of the entire philosophy, so let's spend a moment with it. What it means is that everything, and I mean everything, that can possibly affect a market's price is already reflected in that price. All the economic data, the news headlines, the political events, the investor sentiment, the hopes, the fears, it's all been baked into that single number you see on the screen. The fundamental analyst tries to understand the market by studying the ingredients, the company's earnings, the industry's health, the state of the economy. But the technical analyst, the chartist, says, why study the ingredients when you can just taste the cake? The price is the final result. It is the truth. It's like looking at the final score of a football game. The score already accounts for every brilliant play, every costly mistake, every injury, and every coaching decision. You don't need to rewatch the entire game to know who won. The score tells the story. So, if the price already reflects everything, then the only thing we truly need to study is the price itself. This is a liberating idea. It means you don't have to be an expert in agriculture to trade corn, or an expert in monetary policy to trade currencies. You just have to be an expert in reading the story that the price is telling you. The second unbreakable rule is, prices move in trends. This might sound obvious, but it's a direct challenge to the academic idea of the random walk, which suggests price movements are completely random and unpredictable. The chartist looks at that and says, just open your eyes. A market in motion tends to stay in motion, just like Newton's first law. A trend, once established, is more likely to continue than it is to reverse. This is the whole point of our work. We are not trying to predict the future out of thin air. We are trying to identify the current trend, ride it for as long as it lasts, and get off when it shows signs of ending. Our job is to be trend followers. Think of the market as a powerful river. You can try to paddle against the current, and you might make a little progress here and there, but it will exhaust you. Or, you can simply get in your boat, point it in the direction the river is already flowing, and let the current do most of the work for you. Our goal is to figure out which way the river is flowing. And the third and final rule is, history repeats itself. This is perhaps the most human of the three rules. The patterns that we see on charts, which have been identified and studied for over a century, are not mystical signals. They are pictures of human psychology. And human nature doesn't really change. The way people react to fear and greed today is the exact same way they reacted to fear and greed 100 years ago. When we see a certain pattern forming on a chart, we can say, I've seen this story before. I know how it usually ends. Because these patterns have worked in the past, we assume they will continue to work in the future. The key to understanding the future, the chartist believes, lies in a deep and respectful study of the past. So, let's recap our three unbreakable rules. The price is the truth. The market moves in trends. And the story of the market is the story of human nature, which never changes. With that philosophy as our compass, we can begin to learn the actual language. And to do that, we have to go back in time, to the turn of the 20th century, to meet the man who first started listening to the market's heartbeat, Charles Dow. Charles Dow was a journalist, and in 1882, he and his partner Edward Jones founded a little company you might have heard of, Dow Jones and Company. They started publishing a newsletter that would eventually become the Wall Street Journal. Dow wanted a way to gauge the health of the American economy. So, he created an average of the most important stocks of his day, mostly railroads and a few industrial companies. You know them today as the Dow Jones Industrial Average and the Dow Jones Transportation Average. But Dow did more than just create averages. He watched them. He studied them. And in a series of editorials, he laid out the first coherent theory of how markets behave. He never wrote a book, but his ideas became the foundation for everything that followed. He is the grandfather of technical analysis. And the most important concept he gave us was a simple, timeless definition of a trend. He said an uptrend is simply a series of successively higher peaks and higher troughs. Imagine walking up a staircase. Each step up is a new peak. Each flat part of the step is a trough. As long as you're making higher peaks and higher troughs, you're in an uptrend. A downtrend, of course, is the opposite, a series of lower peaks and lower troughs. Like walking down a staircase. It's that simple. That's the core definition we still use today. But Dow added a beautiful layer of complexity to this. He compared the market's movements to the ocean. He said every trend has 3 levels of magnitude, just like the sea. First, there is the primary trend. This is the tide. It's the major, long-term direction of the market, lasting for more than a year, sometimes for several years. Is the tide of the market coming in a bull market or going out a bear market? This is the most important force. Second, there is the secondary trend. These are the waves. They are corrections or movements that go against the tide. In a major bull market, a secondary trend would be a decline lasting a few weeks or a few months before the primary uptrend resumes. These waves are a natural part of the market's rhythm. And finally, there is the minor trend. These are the ripples on the waves. They are the daily or weekly fluctuations that are ultimately the least important in the grand scheme of things, though they can cause a lot of noise and distraction. A wise analyst, like a wise sailor, always knows the direction of the tide. They may use the waves to maneuver, but they never fight the tide. This brings us to a crucial point that many beginners miss. Markets don't just go up or down. There is a third direction, sideways. This is when the market enters a trading range, with horizontal peaks and troughs. It's like a lake, not a river. It's a period of equilibrium where the forces of buyers and sellers are in balance. Dow called this a line. Why is this so important? Because most trading strategies are designed for trending markets, for rivers. They don't work in lakes. During these sideways, trendless periods, many traders get frustrated. They keep trying to find a direction that isn't there. Sometimes, the wisest decision a trader can make is to recognize they're looking at a lake, not a river, and simply stand aside. To do nothing. So, now we have a definition of a trend. We know there are three types, and three directions. But how do we see them on a chart? And where do these trends pause or reverse? This leads us to the next fundamental building block of chart analysis, the battlegrounds. Every story needs a setting, a landscape. In the market, that landscape is defined by two powerful invisible forces, support and resistance. A support level is a price level below the current market where buying interest is strong enough to overcome selling pressure. It's a floor. Think of it as a trampoline. When the price falls to that level, it tends to bounce back up. This floor is usually created by a previous low point on the chart. A resistance level is the opposite. It's a price level above the market where selling pressure is strong enough to overcome buying interest. It's a ceiling. When the price rises to that level, it often gets turned back down. This ceiling is usually created by a previous peak. In a healthy uptrend, we see a rising staircase of support and resistance levels. The old ceiling becomes the new floor. In a downtrend, we see a descending staircase. The old floor becomes the new ceiling. But this isn't just abstract geometry. There's a deep and fascinating human psychology at work here, and understanding it is the key to understanding why support and resistance are so powerful. Imagine a stock has been trading sideways around $50 for a few weeks, and then it suddenly shoots up to $60. There are three groups of people watching this, and their emotions are what create the magic. Group 1. The buyers. These are the people who bought the stock at $50. They're happy, but they're kicking themselves. I should have bought more, they think. If it ever comes back down to $50, I'm loading up. Group 2. The sellers. These are the people who sold their stock at $50, or worse, shorted it, betting it would go down. They are now in a state of deep regret. They realize they made a mistake. Please, just let it come back to $50 so I can get out without a loss, they pray. If it does, they will buy to cover their short positions, adding to the buying pressure. Group 3. The uncommitted. These are the people who are watching from the sidelines. They saw the stock at $50 and thought about buying, but they hesitated. Now that it's at $60, they're filled with the fear of missing out. They make a resolution: if I ever get another chance to buy it at $50, I won't hesitate this time. Do you see what's happened? All three groups, for different emotional reasons, greed, fear, regret, have all decided to do the same thing: buy the stock if it dips back to $50. That $50 level has now become a psychological battleground, a floor of buying interest. It has become support. The same logic applies in reverse for resistance. A previous peak becomes a ceiling of selling pressure created by the emotions of those who are desperate to sell at that price. The more trading that happens at a certain level, and the more recent it is, the stronger that support or resistance becomes, because more people have a vested emotional interest in that price. And here's one of the most elegant concepts in all of technical analysis: the reversal of roles. What happens when a powerful resistance ceiling, say at $100, is finally broken? What happens when the price pushes through to $105? That old ceiling at $100 now becomes the new floor. Why? Because of that same psychology. Everyone who sold at $100 now realizes their mistake. Every short seller is in pain. Everyone on the sidelines feels left behind. On the next small dip, where do you think they will all be looking to buy? Right at that old resistance level of $100. A broken ceiling becomes a new floor. A broken floor becomes a new ceiling. This principle is constantly at play, creating the very structure of market trends. Now that we understand the landscape of support and resistance, we can start to see the stories that play out upon it. In the world of charting, these stories are called price patterns. They are recognizable shapes that appear on the charts and can help us forecast whether a trend is likely to continue or reverse. I don't want you to think of these as just abstract drawings. I want you to see them as the great dramas of the market, the visual record of the epic battle between the buyers, the bulls, and the sellers, the bears. There are two main categories of patterns. The first are reversal patterns. These signal that a major trend is coming to an end. The second are continuation patterns. These suggest that the market is just taking a brief rest before continuing on its original path. The art is in learning to tell the difference. Let's start with the most famous reversal pattern of all, the head and shoulders top. I want you to picture the story of a powerful king losing his throne. The market has been in a strong uptrend for months. That's the setup. The bulls are in complete control. First, we see the left shoulder. The market rallies to a new high, and then pulls back on profit-taking. This is normal. The kingdom is strong. Then comes the head. The bulls gather their strength and push the market to an even higher high. This is the peak of the kingdom's power. Everyone is euphoric. But then, the market pulls back again, down to a similar level as the previous pullback. And now comes the critical moment, the right shoulder. The bulls try one more time to rally. They try to reclaim their former glory. But this rally is weaker. It fails to reach the height of the head. This is the first major sign of weakness. It's the king's army making one last, tired charge and being repelled. These three peaks, the left shoulder, the higher head, and the lower right shoulder, form the pattern. But the story isn't complete until the final, decisive blow. The two low points of the pullbacks can be connected with a line. This is called the neckline. Think of it as the castle wall. The sell signal, the confirmation that the king has been dethroned and a new downtrend has begun, occurs when the price breaks below that neckline. The castle wall has been breached. The uptrend is over. The head and shoulders pattern is a beautiful, visual story of a powerful trend losing momentum, failing on its final attempt to advance, and then decisively breaking down. The inverse version, with three troughs instead of three peaks, signals a major market bottom and the beginning of a new uptrend. Another classic reversal story is the double top or double bottom. This is the story of a second chance and a final failure. Imagine the market rallies to a peak, say at $120, and then pulls back. This is our resistance ceiling. The bulls, undeterred, launch another assault on that $120 level. They try with all their might to break through. But they are turned back again. That second failure is the key. It's like a boxer getting knocked down, struggling back to his feet, and then getting knocked down again for the final time. The inability to break through that resistance ceiling on the second attempt shows that the buyers have exhausted themselves. The bears are now in control. The reversal is confirmed when the price breaks below the low point of the trough between the two peaks. This M-shaped pattern is a double top. Its opposite, a W-shaped pattern, is a double bottom, a powerful signal that a downtrend has ended. Now, what about those times when the market is just catching its breath? These are the continuation patterns. They tell the story of a pause, not an ending. The most common are triangles, flags, and pennants. Imagine a triangle. After a strong move up, the price action starts to narrow. The peaks get slightly lower, and the troughs get slightly higher. The market is coiling, like a spring. The battle between the bulls and bears reaches a temporary stalemate, but the energy is building within that narrowing range. Usually, the market will eventually break out of the triangle in the same direction it was heading before. The triangle was just a period of consolidation before the next leg of the journey. Flags and pennants are similar stories. After a sharp, nearly vertical price move, the flagpole, the market will trade sideways in a small, compact pattern for a short time, a little rectangle a flag or a tiny triangle a pennant. This is just the market taking a quick rest after a sprint, before taking off again. Learning to identify these patterns, the head and shoulders, the double tops, the triangles, is like learning to recognize the key plot points in a story. They give you clues about what might happen next. But a story is more than just plot. It has emotion. It has intensity. It has a voice. To understand that deeper layer of the market's narrative, we need our next set of tools, volume and oscillators. First, let's talk about volume. Volume is simply the number of shares or contracts traded in a given period. I want you to think of volume as the voice of the market. It tells you how much conviction, how much emotion, is behind a price move. A price move on low volume is like a whisper. It's tentative, uncertain. Maybe it's real, maybe it's not. But a price move on high volume, that's a shout. It signals commitment, enthusiasm, and participation. It tells you that a lot of people are placing their bets with conviction. Volume should always confirm the trend. What does that mean? In a healthy uptrend, we want to see volume increase as prices rise and decrease as prices pull back. We want to hear the market shouting on the way up and whispering on the way down. This tells us that the enthusiasm is with the bulls. If you see the opposite, if prices are rising but the volume is drying up, it's a warning sign. It's like a party where the music is still playing but people are starting to leave. The energy is fading. The trend may be in trouble. When you're analyzing a chart pattern, volume is your truth detector. A breakout from a pattern on a huge surge in volume is far more likely to be real and significant than one that occurs on weak volume. In the futures markets, there's a cousin to volume called open interest. You can think of this as the total number of bets on the table. It's the number of contracts that are still open and haven't been closed out. We look for open interest to rise in a healthy trend. It tells us that new money and new players are entering the market, fueling the move. If prices are rising but open interest is falling, it means people are closing their bets and leaving the game. It's another warning that the trend's foundation is weakening. So, volume gives us the market's voice. Our next set of tools gives us the market's heartbeat. These are called oscillators. Imagine the market is like a rubber band. You can stretch it up, and you can stretch it down, but you can only stretch it so far before it's likely to snap back. Oscillators are mathematical tools that help us see how far the rubber band has been stretched. They measure the speed and momentum of price movements, and they oscillate between two extremes, usually plotted at the bottom of a price chart. When the oscillator reaches the upper extreme, we say the market is overbought. It's moved too far, too fast. It's gotten overexcited. It might be due for a rest or a pullback. It doesn't mean you should immediately sell, but it's a sign to be cautious. The rubber band is stretched tight. When the oscillator falls to the lower extreme, we say the market is oversold. It's fallen too far, too fast. The pessimism has gotten extreme. It might be due for a bounce. The rubber band is stretched in the other direction. There are many popular oscillators, like the Relative Strength Index RSI, stochastics, and the MACD Moving Average Convergence/Divergence. They all measure momentum in slightly different ways, but the core concept is the same. They are the market's heartbeat monitor. And this leads to one of the most powerful signals in technical analysis: divergence. This is a huge clue. A divergence occurs when the price makes a new high, but the oscillator fails to make a new high. Think about that. The price is still climbing, but the momentum, the energy behind the climb, is weaker than it was before. The heartbeat is getting fainter. This is a classic warning sign that the trend is running out of steam. It's like a runner who is still moving forward but is clearly exhausted and about to collapse. The price is telling you one story: we're still going up, but the underlying momentum is telling you a different, more truthful story: we're losing power. This divergence between price and momentum often precedes a major trend reversal. Before we leave our toolkit, there's one more essential tool we must discuss, and it's perhaps the most widely used of all: the moving average. If the daily price action is the noisy chatter of the market, a moving average is a tool that helps us smooth out that chatter to hear the underlying conversation. It's simply the average price of a market over a specific number of periods, say, the last 50 days or 200 days. This creates a single smooth line on our chart. And this line is incredibly useful. It acts as a dynamic, curving zone of support or resistance. In an uptrend, prices will often pull back to the moving average line and then bounce off it, as if it were a magnetic floor. In a downtrend, it will act as a magnetic ceiling. The most basic signal is a crossover. When the price, which has been trading below its moving average, decisively crosses above it, it's a signal that the trend may be turning from down to up. When it crosses below, it's a signal the trend may be turning down. Traders also watch for when a shorter-term moving average like the 50-day crosses above a longer-term one like the 200-day. This is famously known as a golden cross and is considered a very bullish, long-term signal. The moving average helps us define the trend in a clear, objective way. If the price is above its 200-day moving average, the long-term trend is generally considered to be up. If it's below, the trend is down. It helps cut through the daily noise and keep our focus on the tide, not just the ripples. So, we've covered a lot of ground. We started with the 3 unbreakable rules of our philosophy. We learned Dow's definition of a trend. We explored the psychological battlegrounds of support and resistance. We learned to read the stories of chart patterns. And we added color and context with volume and oscillators and moving averages. Learning these tools is one thing. But being a craftsman is another. This is where we reach the grand synthesis of our journey. A great technical analyst, as John Murphy teaches, never relies on a single tool or a single signal. That's a recipe for disaster. Instead, they look for confluence. They look for a moment when multiple, independent tools all start telling the same story. Imagine you see a head and shoulders top forming, a bearish story. That's your first clue. Then, you look at the volume. You see that the volume on the final rally to the right shoulder was weak, much weaker than on the head. The voice of the market is confirming the weakness. That's your second clue. Then, you look at your oscillator, the RSI. You see a bearish divergence? The price made a higher high at the head, but the RSI made a lower high. The market's heartbeat is confirming the loss of momentum. That's your third clue. Finally, the price breaks below the neckline, and it does so on a huge spike in volume. Do you see the power in this? It's not just one signal. It's a convergence of evidence. The chart pattern, the volume, and the oscillator are all singing the same bearish song. It's at this moment of confluence that the chartist can act with the greatest confidence. Not because they are certain about the future, no one is, but because the probabilities have shifted dramatically in their favor. The book provides a kind of technical checklist. It's a systematic way to look at a chart, starting with the biggest picture, the long-term trend, and gradually zooming in. What is the major trend? Where are the key support and resistance levels? Are there any major patterns developing? What is the volume telling me? Are the oscillators confirming the price action? It's this disciplined, multi-layered approach that separates the professional from the amateur. It's about building a case, piece by piece, until the story of the market becomes clear. Technical analysis, in the end, is not a crystal ball. It is not a magical system for getting rich quick. It is a methodology, a discipline, based on the simple idea that the market's past and present behavior gives us powerful clues about its most probable future path. It's a craft that combines a bit of art and a bit of science, but is rooted, always, in the timeless and unchanging reality of human psychology. Commentary. As we step back and reflect on the world John Murphy has opened up for us, what is the single most powerful lesson we can take away? For me, it is this: technical analysis is not about predicting the future. It is about managing risk and identifying probabilities. It's a profound shift in mindset. The amateur asks, what is the market going to do? The seasoned technician asks, where is the trend now? And where is the point at which I will know my thesis is wrong? The beauty of a trend line, a support level, or a moving average is that it gives you an objective line in the sand. It provides a framework for making decisions based on evidence, not on emotion or hope. It allows you to say, I will stay with this uptrend as long as the price remains above this trend line. If it breaks, my story is changed, and I will get out. This discipline, this focus on risk management, is the true secret of longevity in the markets. In today's world, these principles are more relevant than ever. Markets are faster, more global, and more accessible than Murphy could have ever imagined when he first started. We have stocks, forex, crypto, and countless derivatives, all trading 24/7. But what hasn't changed? Human nature. The fear and greed that drove markets a century ago are the very same emotions driving them today. They just happen faster. And because charts are simply a picture of that human emotion, their lessons are timeless. The head and shoulders pattern on a Bitcoin chart tells the exact same story as one on a railroad stock chart from 1930. So, how can you, a curious 17-year-old, begin to apply these ideas today, without risking a single dollar? Here are 3 simple, practical actions you can take. First, pick a stock, a commodity, or a cryptocurrency that you find interesting. Don't buy it. Just go to a free charting site like TradingView or Yahoo Finance and pull up its chart. Set it to a 1-year daily view. Your only job is to look at it and answer one question. Based on Dow's definition of peaks and troughs, what is the primary trend? Is the tide generally coming in or going out? Just practice seeing the main direction. Second, on that same chart, try to draw one simple trend line. Find 2 clear low points in an uptrend and connect them with a line. Extend that line out to the right. Or find two clear high points in a downtrend and connect them. Now, just watch what happens in the following days and weeks. Does the price seem to respect that line? Does it bounce off it? Does it treat it as a floor or a ceiling? You will be amazed at how often the market seems to remember where that line is. Third, add one moving average to your chart. A 50-day moving average is a great place to start. Just look at it. Is the price currently above or below that smooth line? Notice how, during the trend, the price will often come back to kiss the average before moving away again. It's a simple visual anchor that can instantly tell you if the bulls or the bears have the upper hand in the intermediate term. The charts don't create the market's behavior. They are simply a mirror, reflecting the collective hopes, fears, and decisions of millions of people around the world. Learning to read them is like learning to understand the human heart on a massive, global scale. It's a skill that teaches you about psychology, about probability, and about discipline. And that is a skill that will serve you not just in the world of finance, but in understanding how the world, and the people in it, truly work. That was a summary of Technical Analysis of the Financial Markets by John J. Murphy. We've certainly walked through the core principles today, but I'll be honest with you, a summary can only ever be a map. The real adventure happens when you decide to explore the territory for yourself. It's in the quiet moments of study, when a particular pattern or a simple concept clicks in your mind in a way you never expected. This overview is designed to help you decide if this journey is one you want to take. If anything we've talked about today has sparked your curiosity, I encourage you to pick up a copy. Reading it isn't just about learning. It's an experience that can fundamentally change the way you see the rhythm of the world around you. You can find a link to the book in the description below. Also, if you found this exploration valuable, it would mean the world to me if you would click that like button and subscribe to the channel. That way, you won't miss our next deep dive into another life-changing book from the world's most successful minds. Let's keep learning and growing together.